You mentioned that we are in a large bubble that is about to burst. Can you elaborate on that and how this is likely to unfold as modern nations print money at the scale we're seeing in Japan, the United States, Europe, etc.?
We are entering uncharted territory in terms of scale. There has never been anything like what we are doing now, and we know from what has happened in other nations that printing too much money eventually causes terrible problems. We are closer to terrible problems than we have been in the past. After the 1970s, Volcker raised interest rates to 20%, and the government paid 15% on its bonds. This caused a very severe recession that lasted a long time and brought much suffering. I hope we do not return to that situation. The conditions that allowed Volcker to take such drastic measures, without politicians interfering, were very special. In hindsight, it was a good decision. I do not think today's politicians would allow a new Volcker to be so harsh on the economy and trigger such a strong recession. I believe the new problems will likely differ from the old ones. You might wish you had a Volcker-style recession instead of what you are about to endure. The problems coming our way could be worse than what Volcker tackled and harder to fix. Consider Latin American countries that print too much money. They often end up under control of authoritarian leaders and power figures. This resembles what Plato described about early democracies in Greek city-states. When there is one person, one vote, and much equality, demagogues emerge. These demagogues are in the favor of the people, and over time, democracy vanishes. I do not think Plato was wrong. In fact, I believe he accurately described what happened in Greece and what has occurred repeatedly in Latin America. We do not want to repeat that history. At least I don't. We have done something quite extreme, and we do not know what the consequences will be. Will we end up like Japan or something far worse? What makes life interesting is that we do not know how this will play out. I think we know we are flirting with serious trouble. I also believe some of our past fears were exaggerated. Japan still exists as a civilized nation, despite an incredible excess, by all prior standards, in money printing. Think about how seductive it is. You have a pile of interest-bearing debt, and pay it off with non-interest-bearing checking accounts. Think how tempting this is for a group of legislators. You eliminate interest payments, and the money supply grows. It seems like heaven. And of course, when something is so seductive, it is likely to be overused. If you pause to reflect, my path in life was not about predicting short-term differences between the Russell Index and the Standard & Poor's. I have no opinion on which index is better at any given moment. I never think about that. I am always looking for something good enough to invest my money in, to swim as best I can against the tides. I am not trying to predict the tides. If you invest in stocks long-term or in real estate, there will naturally be periods of agony and periods of boom. I think you simply have to learn to live with them. As Kipling said, treat those two impostors, triumph and disaster, the same. You must deal with day and night. Sometimes it is night, sometimes day, sometimes boom, sometimes crisis. I believe in doing the best you can, and moving forward as long as you are allowed. What impact would you say passive investing has had on stock valuations? Oh, enormous. And it is accelerating. We now have a new group of emperors, the people who control voting in index funds. Perhaps we could turn Larry Fink and the folks at Vanguard into modern-day popes. Suddenly, we have seen a massive transfer of decision-making power to these passive index funds. This will change the world, and while I do not know the consequences, I predict it will not be good. Our economy and technological civilization are incredibly strong and will not disappear. Knowledge and advancements keep growing. You cannot imagine what a modern factory looks like when filled with robots, and this transformation is advancing rapidly, even in China. These trends are inevitable and, in turn, create adaptation challenges. If you have a good union job and are replaced by a robot, you have a big problem. If you own a company like Kodak and a new invention renders your product obsolete, you also have a problem, and you solve it by dying. Many people dislike that solution. All these problems are real, and it is tempting to eliminate debt by creating money out of thin air. Where you once had to pay interest monthly, now you just give someone a non-interest-bearing checking account. This not only creates a serious problem, but also makes money printing the easiest solution for politicians and the Federal Reserve when addressing temporary issues. Of course, this easy fix carries long-term risks. We know what happened in Germany when the Weimar Republic kept printing money uncontrollably. Everything exploded, and that collapse contributed to Hitler's rise. It is a dangerous and grave situation. We do not want politicians acting under the belief that since nothing happened last time, they can do it again, then double down and repeat the cycle endlessly. History shows that unchecked money printing inevitably leads to a very different government if prolonged. Playing with this temptation is risky unless there is discipline in the process. That said, I do not think Japan is in imminent danger. They have engaged in these practices extensively and somehow manage well. However, I do not believe we are as adept at handling our problems as Japan has been. If taxes were not an issue, what are your thoughts on moving to cash now and waiting for better opportunities to deploy it over the next 12 months? Is this a sensible idea in your view? In my entire adult life, I have never hoarded cash waiting for better conditions. I have simply invested in the best opportunities one could find, and I do not think I will change now. The Daily Journal uses its cash. Berkshire has excess cash, quite a lot. But it is not doing so because it thinks it can time investments. It simply cannot find anything it is willing to buy. So we do not have a solution to your problem. We are just dealing with it as I described. Why isn't Berkshire acquiring or adding new companies to the portfolio? Congratulations to the team on buying Apple stock a couple years ago. That's paying off for sure. The reason we are not buying is that we cannot purchase anything at prices we are willing to pay. It is that simple. Others are bidding up prices, and much of the buying is not by people who truly plan to hold long term. Much of this is commission-driven. Private equity buys things that earn more fees by having more assets under management. Of course, it is easier to buy something using someone else's money. We are using our own money. At least that is how we see it. I have always believed nothing is worth an infinite price. Even a wonderful place like Costco could reach a price where we would say it is too high. But I would argue that if I were investing money for a sovereign wealth fund or pension fund with a 30-, 40-, or 50-year horizon, I would buy Costco at today's price. I think it is such a strong company that, over the very long term, it would deliver. It is no tragedy that Berkshire has some uninvested cash. In fact, it makes us appear more responsible in wealth management. And we are. Shareholders worried about the future because it seems complex, difficult, and dangerous. I want to tell them what my old professor told me. Charlie, tell me your problem, and I'll try to make it harder for you. He did me a favor by treating me that way, and I am repeating his favor for you. When you reflect on these topics, at least you are heading in the right direction. Worrying about what truly matters. Inflation, for example, is a very serious issue. One could argue it is one of the ways democracies die in Latin America. When a democracy collapses, inflation often plays a major role. This makes it an enormous danger. Once the population realizes it can vote to give itself money, overdoing this path ends up destroying civilization. But of course, it is a long-term danger. Looking at the Roman Republic, even after transitioning to an empire with an absolute ruler, they constantly debased their currency for hundreds of years, and eventually the entire damn Roman Empire collapsed. So it is probably the greatest long-term danger we face, aside from nuclear war. I think the safe assumption for an investor is that, over the next 100 years, the currency will go to zero. That is my working hypothesis. It is a very dangerous environment. What brought Hitler was a combination of Weimar inflation, which wiped out the German middle class's savings, followed by the Great Depression. It was a double blow, and Hitler stepped in, a mad demagogue with 40% of the vote, soon becoming a dictator bent on World War II. History is not kind, and Germany was a highly advanced, civilized nation. The Germany Hitler took over. I always say the interesting thing was that little Albert Einstein, a small Jewish boy, received all his primary education at the insistence of the Catholic Church in Germany. That is a very civilized nation. So if you let your nation decay too much, what you get is a Hitler. In a modern democracy, especially in the Keynesian era, it is normal for governments to react forcefully to crises. This time, however, the response was larger than any in U.S. history. They essentially threw money at the problem. Perhaps they were right to fear what might have happened and chose a fairly generous response. But they probably overdid it a bit, injecting so much money so fast that even restaurants now struggle to hire staff. Still, I do not criticize them. Making decisions under pressure is never easy. How do you think this will play out? What advice would you give individual investors to mitigate inflation's negative impact, aside from investing in quality stocks? Well, you may have to choose the least bad option among a group of choices. That often happens in human decision-making. We own Berkshire stock, Costco stock, Chinese stocks, a bit of Daily Journal stock, and a lot of apartment buildings. I think it is perfect. Yes, I think the big lesson for managers is that you do not need all this diversification. It is enough if you're lucky to have 4 good assets. Finance professors sell the idea that diversification is professional investing. If you are trying to beat the average, you are lucky to have 4 things to buy. Getting 20 is very complicated. Very few people have the brains to find 20 good investments. It will be much harder for today's college graduates to get rich and stay rich. It will be far harder for them than it was for my generation. Consider the cost of owning a home in a desirable neighborhood in a city like Los Angeles. I think we will likely end up with higher income taxes, too. The investing world is quite tough, and I do not think my lifetime, 98 years, was the ideal time to own a diversified portfolio of common stocks, updated slightly by adding new entrants like Apple and Alphabet. I would say people earn maybe 10 to 11% have done very smartly before inflation, and perhaps 9% after. That was a wonderful return. No other generation in history got returns like that, and I do not think the future will give this year's graduates such an easy investment opportunity. Some people have enough talent to invest in hard-to-value assets. Others would be wise to have more modest ambitions. So you must figure out your skill level or your advisors and let that guide you. But to all who find today's investment climate difficult and confusing, I say, welcome to adulthood. S&P 500 index funds make up about 75% of the market. That's why I don't think the issue you mention is as severe in the standard case. But is there a point where index funds could stop working? Of course. If everyone bought nothing but index funds, the entire world would not function as people expect. Another problem is that buying a large index like the S&P works, because if you buy a small index that becomes popular, you get a self-destructive situation. When the Nifty 50 were in vogue, J.P. Morgan convinced everyone to buy just 50 stocks, regardless of price. Over time, their own buying forced those 50 stocks up to 60 times earnings, after which they crashed, falling by about 2/3. In other words, overconcentration in a sector or narrow index can lead to catastrophic shifts, as with the Nifty 50. For context, the Nifty 50 were a group of 50 popular U.S. stocks in the 1960s, 70s, seen as safe, stable growth investments. Their sky-high price-to-earnings ratios led to a belief in invincibility. But during the 1970s crisis, many collapsed, proving extreme valuations do not guarantee long-term success. The term is now used ironically for overvalued stock groups. I do not see this happening when the index is 34% of the entire market. The issue is it cannot work perfectly forever, but it will work for a long time. Indexes have caused absolute agony for smart investment professionals, as 95% of people have almost no chance to beat them over time. Yet many expect hiring someone will let them outperform, which honest advisors know they cannot fully deliver. Most people handle this with denial. They think next year will be better. They avoid thinking about it. I get it. I do not dwell on my own death either, but it is a terrible problem. Outperforming indexes is a new challenge for professionals. Money management costs keep dropping to as low as 20 basis points, disrupting the industry. Those who rose to the top did not do so charging such low fees. For managers handling large U.S. equity portfolios, this is a huge problem. It makes today's generation face far more difficulties, rightfully so. I would hate managing $1 trillion in big stocks trying to beat indexes. I cannot do it. Berkshire's success came from making about 100 decisions in its lifetime, 2 per year. We outperformed not by building massive portfolios, but by making 2 major decisions annually for 50 years. Why should life be easy? Indexes are a big challenge, but that is inevitable. Now, computer algorithms used for successful trades get copied, reducing returns. Worldwide, realizable returns are pressured downward by technology and competition. The first rule of a happy life is low expectations, easy to handle. Unrealistic expectations make you unhappy. I was always good at low expectations. It helped when facing trouble. Enduring and moving forward helps. Overworrying leads to misery. Certain rules of conduct matter. Rose Blumkin impacted Berkshire's culture. She started a business with $500 during the Depression, growing it massively. Her mottos: always tell the truth and never lie to anybody about anything. Simple but powerful rules. Many of life's best rules are simple, like do it right the first time. Many ask today about the secret to a long, happy life. It's easy. No envy, no resentment, live below your income, stay cheerful despite troubles, deal with trustworthy people, and do what you ought to do. These simple rules work well and are precise. How old were you when you figured this out? About 7. I could see some elders were a little crazy. I always recognized irrationality in others. It helped. There is so much irrationality in the world. I have been thinking about it for a long time.